Assalamualaikum warahmatullahi wabarakatuh. My team will be present for chapter 26, which is internal and governmental financial auditing and operational auditing. My team consists of me, Arafah Haina, Alia Fahanis, Nohanis Najwa, Anis Afika, Fatin Asman Najiha, Alkis Danisha, and lastly Noaina Nazira. So firstly, what is the internal financial auditing? Internal financial auditing is an independent objective assurance and consulting activity designed to add value and improve an organization's operations. It also helps an organization accomplish its objective by bringing a systematic, disciplined approach to evaluate and improve the effectiveness of risk management, control and governance processes. The objective of internal auditor is also reviewing the reliability and integrity information. Second, ensuring compliance with policy and regulation. Last but not least, safeguarding assets. The objective internal control are considerably broader than the objective of external auditor. This is because, for instance, at one company, internal auditor may focus on exclusively on documenting and testing control, while the other company, internal auditor may serve primarily as consultant, focusing on recommendation that improve organizational performance. Next, the professional guidance for internal auditor is provided by Institute of Internal Auditor Malaysia, IIAM, an organization similar to the AICPA that establishes ethical and practice standards. For Institute of Internal Auditor Ethical Principle and Code of Ethics, there are 4 rules of conduct. Firstly, integrity, which means that the internal auditor should be honest and ethical in everything they do. This means being truthful in their reports, avoiding conflict and interest, and reporting any wrongdoing they observe. Secondly, objectivity. Internal auditors should conduct their work with impartiality and avoid bias. They should base their judgment on facts and evidence, not personal opinions or external pressure. Thirdly, confidentiality. Internal auditor must keep all information they obtain during their work confidential. These include financial information, personal data, and other sensitive detail. Lastly, competency. Internal auditors should have the necessary skill and knowledge to perform their job effectively. They should stay up to date on the latest accounting and auditing standard and best practices. Meanwhile, the Institute of Internal Auditor Professional Practice standards consist of attribute standards and performance standards. Attribute standards is addressed the attributes of organization and individual performing in internal auditing. Performance standards is describe the nature of internal auditing and provide quality criteria against which the performance of these services can be measured. Next, we're gonna move on to the next slide, which is this slide is about ISA 610 using the work of internal auditors. This is the example of 3 main factors external auditor needs to consider when deciding to rely on internal audit. By evaluating the following. First, the extent to which the internal audit functions, organizational status and relevant policies and procedures supports the objectivity of the internal auditor. This means the internal audit team should be independent and free from bias. Next, the level of competence of the internal audit function. The internal auditors need to have the skill and knowledge to do their job effectively. They should understand accounting rules, auditing standards, and the specific industry and the company they work in. Last but not least, to check whether the internal audit function applies a systematic and disciplined approach, including quality control. This means the internal audit team has a documented plan for how they conduct audits and follows quality control procedure to ensure their work is accurate and reliable. So this is the vice versa. We take a look at this slide, which the slide shows the situation where the external auditor might not rely on internal audit. These are basically the flip side of the previous slide. First, the function, organizational status and relevant policies and procedures do not adequately support the objectivity of internal auditor. In the short word, maybe the internal audit team doesn't have enough independence or there's no clear process for resolving disagreements with management. This could raise concerns about bias. Next, we go through to competence. Perhaps the internal auditors lack the necessary skill or knowledge. They might not be familiar with the latest accounting standards or have a deep understanding of the company's specific businesses. Last but not least, the internal auditor in that company might be does not apply a systematic and disciplined approach, including quality control. If the internal audit team doesn't have a documented methodology or doesn't follow quality control procedures, the external auditor might not trust their work. To sum up, the external auditor use their judgment to decide if the internal audit teams meet this criteria. If they have concern, they will need to do more of their own testing. But when the internal audit function is strong, it can save external auditors' time and resources. So that's all from me. I will pass to the next presenter.
Assalamualaikum and hi, my name is Alia Fanis. Now I will explain my parts. First, I would like to discuss the crucial partnership between internal and external auditors. Both play distinct yet interconnected roles in safeguarding an organization, financial health and transparency. For internal auditors act as the guardian of an organization internal control. They are the in-house investigators constantly assessing internal processes, risk management practices and adherence to company policy. The objectivity is paramount, ensuring their evaluation and unbiased are free and from internal influence. They leverage their competency, their knowledge and skills to identify areas for improvement and enhance the organization overall governance. But meanwhile, for external auditors function as independent reviewers. They meticulously evaluate the organization financial statements, employing similar audit methodologies such as substantive testing and analytical procedures to external auditors. Their objectivity is critical as they provide an unbiased opinion on the accuracy and reliability of the financial information presented. They are ultimately responsible to the financial statement users such as investor and creditor who rely on the auditor's credibility to make informed decisions. While their specific function differ, both internal and external auditors share a commitment to objectivity. This forms the bedrock of their work, ensuring unbiased evaluation and fostering trust in the financial reporting process. They both utilize the audit risk model, a framework that helps them assess the likelihood of material misstatement in the financial statements. Besides that, internal auditors focus their expertise on internal operation, meticulously examining controls and risk management practices. They report directly to management, providing insight and recommendation for improvement. But for external auditor, on the other hand, concentrate on financial statement audits. They report to the financial statement users, offering an independent assessment of the financial information presented. So in simple terms, internal auditor work diligently within the organization to identify areas for improvement and strengthen internal processes. External auditors provide an independent perspective, verifying the accuracy of the financial information presented to external shareholders. Their collaboration is important, fostering transparency and accountability in financial reporting. This partnership creates a robust financial environment, benefiting the organization as a whole. Next part is I want to focus on a crucial aspect of corporate governance: internal controls. These controls are the backbone of a healthy and transparent organization. To that end, I would like to introduce the guidelines to directors on statement of internal control. Firstly, the guideline is to provide guidance to directors of public listed companies in making disclosure in their company's annual report. These guidelines serve as an invaluable resource for directors of publicly listed companies. They provide a clear framework for disclosing internal control information within your annual report. This transparency fosters trust with shareholders and reinforces your commitment to responsible governance. Next, derived from the Turnbull Report 1999. The guidelines draw inspiration from the esteemed Turnbull Report of 1999, which firmly established the importance of internal controls. The report emphasized the director's responsibility to ensure their organization has robust internal control in place. Third, to explain the key areas that director must pay attention before they can make a statement in regards to their company's internal control. The guidelines highlight specific areas requiring director close attention before issuing statements regarding their company's internal control. Next, to emphasize the need for proper risk assessment. The guidelines emphasize the importance of proper risk assessment within your organization. Director must ensure that ongoing risk assessment process exists to identify and mitigate potential threats to the company's financial health and reputation. Besides that, to evaluate the adequacy and the integrity of their company's system of internal control. Director must evaluate the adequacy and integrity of the company's internal control system. This involves assessing its effectiveness in preventing and detecting errors and fraud, ensuring the accuracy of financial reporting and safeguarding assets. And lastly, directors are also expected to independently consider other areas that are specific to the type of business that they are engaged in. The guideline acknowledges that no single one-size-fits-all approach exists. Director must consider areas specific to their company's business type and industry. This tailored approach ensures controls are relevant and address the unique risks inherent to your operation. So by following this guideline, director gain the knowledge and tools to make informed decisions regarding internal controls. This translates into enhanced transparency for shareholders, strengthened risk management practices, and ultimately a more robust and resilient organization. The next part is governmental financial auditing. For this part, I would like to discuss the critical role of government audit in safeguarding public finance. The cornerstone of government audit is the audit manual issued by Jabatan Audit Negara. This comprehensive manual serves as the primary source of guidance for auditors, providing a clear framework for conducting financial audits of various governmental entities. Jabatan Audit Negara encompasses a broad spectrum of examination, focusing on key areas such as financial statement of governmental units. This statement provides a window into the financial health and performance of these entities, ensuring efficient use of public resources. Next, government contract and grants. Public funds are often channeled through contracts and grants. Auditors carefully review compliance to the terms of these agreements, confirming that the funds are used for the intended purpose and comply with all applicable laws. Next, internal control systems. Any organization needs a strong internal control mechanism. So auditors assess how well this system works within government organization to make sure risks are managed effectively, financial reporting is accurate, and public assets are protected. Besides that, frauds. The prevention of fraud in government spending is important. Auditors keep a close eye out for any unusual event or misuse of public funds and take immediate steps to stop it. Their careful investigation reveals any possible misconduct. And lastly, other non-compliance with laws and regulations. Financial statements are only one aspect of financial audits. So beyond financial matters, auditors look at any possible legal and regulatory violations. This ensures that the government functions within the bounds of the law and covers things like labor law, environmental rules, and safety standards. So the next part is Audit Act 1957. The Audit Act of 1957 is an important component of law that forms the cornerstone of effective financial control in Malaysia. This act is important for maintaining openness and protecting public resources. The Audit Act 1957 established a clear framework for auditing practices across Malaysia. It defines the responsibility and authority of the Auditor General, an independent officer who oversees the auditing process of various entities. The Act empowers the Auditor General to conduct audits of a broad range of entities, ensuring proper financial management. So firstly, the Federation and of the states and funds established in the State of Federal Territory 97. The Act requires states and federal financial transactions involving public funds to be audited. This guarantees the proper use of public funds throughout the country. Second, public authorities. Transparency and accountability extend beyond the government itself. The Auditor General also oversees the financial record of public bodies, fostering responsible financial management within this organisation. Next, other corporate bodies in receipt of a grant or loan from federation or a state. Entities that receive financial assistance from the government, whether through grants or loans, become subject to audit investigation. This ensures these funds are used for their intended purposes and in accordance with established regulation. And lastly, other funds. The Act extends beyond these specific categories. The Auditor General also has the authority to evaluate other funds, ensuring compliance with financial regulation across the board. So in simple terms, the Audit Act of 1957 gives the Auditor General the authority to oversee governmental finances. The Act provides protection for public resources, encourages good governance, and increase openness in the management of public finances by requiring comprehensive audits of different bodies. The public confidence in the government's financial management is strengthened by this strong structure. So the Audit Act 1957 serves as a cornerstone of financial accountability in Malaysia. It ensures that public funds are used responsibly and efficiently for the benefit of the nation. So that's all for me. Thank you.
Thank you to Alia Farhanis for your explanation. My name is Nurish Naja binti Ramlan. Now it's my turn to explain about audit reporting and requirements. It is a formal guidelines and ensure responsibilities fulfilled by the Auditor General, the Constitutions and Audit Act 1957. Besides that, it also have standard basis, which is first, Audit Act 1957. This act should apply to the audit of the accounts of the Federation, of the states and of such other public authorities and specific bodies as a subject to audit by the Auditor General. Next, the National Audit Department's practice and experience and the standards used by accounting professions. Besides that, International Organization of the Supreme Audit Institution, which is INTOSAI, has members from 193 countries around the world, and INTOSAI serves as a hub for the community of external government auditors. Lastly, other Supreme Audit Institutions is a public oversight institution which audit government's use of public funds. Next, I want to explain about the financial auditing standard. They have 5 standards that I want to explain. First, materiality and significance. The Yellow Book recognizes that in government audits, the threshold of acceptable audit risk and materiality may be lower than in an audit of commercial enterprise. This is because of the sensitivity of government activities and their public accountability. Besides that, second standard is quality control. Quality control is a audit government entities in compliance with the Yellow Book must have an appropriate system of internal quality control and participate in an external quality control review program. Third, compliance auditing is the audit should be designed to provide reasonable assurance of detecting material misstatement resulting from non-compliance with provisions of contract or grant agreements that have a material and direct effect on the financial statement. Fourth, the standard is reporting. Reporting, which is the audit report, must state that the audit was made in accordance with generally accepted government auditing standard, which is GAGAS. In addition, the report on the financial statement must describe the scope of the auditor's test of compliance with law and regulation and internal control and present the result of those tests or refer to a separate report that includes the information. Lastly, audit files and working papers. Audit file is serve as a comprehensive record of the entire audit engagement. They provide a clear picture of the planning, executions, and completion of the audit. For example, audit program detailing the specific procedures performed to test financial statement, while working paper the detailed records that support the audit procedure performed and the conclusion reached. For example, calculation performed to test the accuracy of financial records. Next, I want to explain about the reporting requirement of Audit Act 1957. First, the requirement is essential accounts and records have not been properly maintained. This means that the organization hasn't kept accurate and complete financial records. Other than that, the requirement is monies have not been fully accounted for. This indicates a discrepancy between the money the organization should have and what it can actually account for. This could be due to theft or fraud and missing records. Next requirement is monies have been expended other than for purposes for which it was appropriate or approved. This means money has been spent on things that weren't originally authorized. For example, funds allocated for a specific project might have been used for something else. Besides that, the requirement is revenues collected or money expended in contraventions of law and established policies. This means that the organization may have collect money illegally or spend money in the way that violate established rules. For example, collecting fees without proper authorizations. The last requirement is the rules and procedures have been insufficient to first safeguard assets and stores. This refers to the need for rules and procedure to be in place to protect the organization assets such as property, cash, and inventory. Second, to secure an effective check on assessment, collection, and proper allocation of the revenues and other receipts. This means that there should be a system in a place to ensure that all revenue is collected and accounted for properly. Lastly, ensure that expenditure have been made only as authorized. This refers to the need for a system to ensure that money is only spent on things that have been approved by the proper authorities. Okay, last but not least, I want to explain about the general guidance of auditors that consists only two. First point is the auditor have good understanding of federal constitutions and other basic law. It is because auditors are responsible for making sure the company complies with all applicable law and rules. This could involve areas like tax laws and employment laws. It also needs good understanding of fraud detections. It needs being aware of the boundaries of the law allow auditors to recognize potentially illegal or fraudulent activities. The reporting could be necessary for an auditor to notify the relevant authorities of any instance of non-compliance with the law. Second point is a good understanding of Audit Act 1957, which is audit concept, standards, and practice. Audit concept are the fundamental principles that guide the auditing process, such as independence, proper professional care, and gathering adequate audit evidence. Audit standards also globally accepted criteria that specify the proper way to perform and report on audit. Consistency and quality in the auditing profession are guaranteed when these standards are met. Lastly is audit practice. These are the particular methods that auditors use to acquire evidence and draw conclusions about the financial statements of a business.
My name is Anis Afika and I will explain about operational auditing. Operational auditing is a process of evaluating a company's operating activities on a day-to-day level and a broader scale. It requires analyzing the processes, procedures, and systems used within the company. The purpose of doing operational auditing is firstly to provide an unbiased evaluation of processes, systems, and operations. Secondly is to determine the effectiveness or efficiency of any part of an organization. Thirdly is to reduce risk and ensure that organizational goals and objectives are met. And these are only a few purposes of operational auditing. How can we differentiate between operational and non-financial auditing. So we can differentiate it by the purpose of the audit, distribution of the reports, and inclusion of non-financial areas. Let's start with the purpose of the audit. So on the left is operational auditing and on the right is financial auditing. So firstly is on the emphasis. For operational auditing, it emphasizes the efficiency and effectiveness of an organization, while for financial auditing, it emphasizes whether historical information was correctly recorded. Next is about what it is the focus. So operational auditing focuses on improving future performance and financial auditing is oriented to the past. For next differences is about risk management. Operational auditing identifies operational risk and controls. Financial auditing is about detecting financial fraud, misstatements, or irregularities. So moving on to the next one is about the objective. So operational auditing, assessing operational performance and controls, while financial auditing, ensuring compliance with accounting standards and regulations. Lastly is about value addition. Operational auditing adds value through process optimization and risk mitigation. And financial auditing provides assurance to stakeholders about financial data. The next difference is distribution of the reports. Firstly is about who is the audience. For operational auditing, the reports are intended primarily for management, and for financial auditing, they are typically distributed to external users of financial statements, such as shareholders, bank, and others. Moving on to next, who perform the audit? The auditors performing operational audits are employees of the company, and since it is done internally, the management has control over it. But for financial auditing, it is done by professionals, which are external auditors that are not controlled by the management. What about the format? In operational auditing, it does not have a standard format, in contrast to financial auditing, as it has a standard format. Next, who has access to the audit reports? For operational auditing, it is not made for the public, but only the management has access to it. For financial auditing, it must be published publicly. And lastly, how frequently does it need to be done? Operational auditing can be done periodically or as needed, often throughout the year. And for financial auditing, it is typically done annually, sometimes semi-annual or quarterly, depending on the companies. The last difference is the inclusion of non-financial areas. First, what does it emphasize? Operational auditing covers any aspect of efficiency and effectiveness in an organization, but for financial auditing, it is limited to matters that directly affect the fairness of financial statements. What is the scope? In operational, it includes both financial and non-financial areas, while in financial auditing, of course, it focuses on financial areas. Next is the depth of analysis. For operational auditing, it does in-depth analysis of non-financial areas, but for financial auditing, it does limited analysis of non-financial areas. The second last point is about the reporting findings and recommendations. In operational auditing, reports include findings and recommendations related to financial and non-financial areas, while for financial auditing, reports primarily focus on financial findings with limited discussion of non-financial areas. Lastly, stakeholder involvement. Operational auditing involves a wide range of stakeholders in contrast with financial auditing, as it only involves a limited number of stakeholders. Now we are going into effectiveness versus efficiency. So, what is effectiveness? Effectiveness refers to the accomplishment of objectives. Effectiveness assesses whether internal processes, procedures, and systems are achieving their intended goals and objectives. It is important because ensuring effectiveness is crucial for organizations to meet their strategic objectives, satisfy stakeholders, and maintain competitiveness in the market. For example, producing parts without any defects. What about efficiency? Efficiency is defined as reducing costs without reducing effectiveness. Efficiency evaluates how well resources are utilized to achieve the desired outcomes. Improving efficiency can lead to cost savings, increased productivity, faster turnaround times, and enhanced competitiveness. It allows organizations to achieve more with fewer resources. Now, this slide is about types of inefficiency. So the first type is inadequate supplier management. Inefficiencies in supply selection, negotiation, or relationship management can result in supply chain disruptions, quality issues, and increased costs due to missed opportunities for cost savings or value-added services. For example, bids for purchases of materials are not required. Secondly, inefficient inventory management. For inventory management, practices such as overstocking, stockouts, or lack of inventory visibility can lead to increased carrying costs, obsolescence, and disruptions in supply chain operations. An example is an assembly line was shut down for lack of materials. Thirdly is overlapping responsibilities. This is when multiple departments or individuals have overlapping responsibilities or perform redundant tasks without clear delineation of roles. It can result in duplication of efforts and inefficiencies. The example is production and accounting keep identical records. Fourthly, process inefficiencies. These occur when internal processes are unnecessarily complex, redundant, or time-consuming, leading to delays, bottlenecks, or wasted resources such as vendors' invoices and receiving reports are filed without being used. And finally, resources misallocation. Inefficiencies arise when resources such as manpower, materials, or technology are underutilized, overutilized, or allocated ineffectively, resulting in inefficiencies and increased cost. For example, office work could be done with one less assistant.
Hi, Assalamualaikum and a very good day. My name is Fatih Asman Najiha and it is now my turn to present my part. So the first part that will be presented by me is the relationship between operational auditing and internal control. So there is three concerns that are important to establish a good internal control, which are efficiency and effectiveness of operations, reliability of financial reporting, and also compliance with applicable laws and regulation. So it is obvious here that the first client concern about internal control is directly related to the operational audit, which is the efficiency and effectiveness of operation. So this concern is dealt by the operational auditing, and auditors do operational auditing to ensure all operation by the client business operated in an efficient and effective manner based on their specific criteria. So this criteria is decided before the operational audit is performed. So if the company have a high internal control, it will result in a high efficiency and effectiveness of the company itself. So the second one, which is the reliability of financial reporting, is rely heavily on the responsibility of ensuring that financial information is fairly presented and comply with approved accounting standard, which is in our case MFRS. So the presented financial information should be free from errors or misstatement to ensure that the information is reliable to the user of that financial statement. So, the example I can give here is, imagine if a manager that needs a reliable cost accounting information to decide on which product to continue or which product to stop producing. So, if they get an unreliable information, it will affect the efficiency of the production. Okay, so we move on to the last one. Clients should comply with applicable laws and regulation, as failure to comply will result a large fine to the company. And not just that, having an ongoing lawsuit will take time and also company resources. Company dealing with this legal issue might have to put other projects on hold, which impacting their effectiveness and also efficiency of overall operations. So we can see here, while the last two seems not directly related to operational auditing, they are actually important in ensuring the effectiveness and efficiency of the client company. Internal controls and operational auditing can be seen here as correlated to each other. So now we move on to the type of operational audit, which consists of 3 types, and we will go one by one. So the first type of operational audit is functional audit. Functions are means of categorizing the activities of a business, such as accounting function or production function. And the function itself may be subdivided more on many different ways, such as the accounting function may be divided into cash disbursement, cash receipt, and payroll function. And a functional audit will deal with one or more function in an organization, for example, concerning the effectiveness and efficiency of the payroll function for a division only or for the company as a whole. So this audit type has the advantage of permitting specialization by auditors, and auditors can develop a considerable expertise in an area, be more efficient and effective when they spend all their time auditing the area or the function. The second type is organizational audit. So organizational audit deal with an entire organizational unit, such as department, branch, or subsidiary. So this type of audit emphasizes how efficiently and effectively function interact. So the example that I can give for things they do in this audit is determining whether their mission, vision, and values is still applicable or already outdated, or whether their mission, vision, and values are aligned with the company goal. So the last type of operational audit is special assignment. So from the name itself, we can know this type of audit not occur for general purpose only. So a special assignment audit will only arise when the management requests for it, for reasons such as the management wants to determine whether the cause of ineffective IT system, or when the management suspect there is possibility of fraud and wants to investigate it. So this audit will only examine on the specific area or aspects, and usually conducted when there is particular concern or suspicion. Next, we move to slide of who perform operational audit. So there are 3 groups that usually perform operational audit. And the first group is the one who we usually listen about, which is internal auditors. Internal auditors is very common with the operational audit, that some people use the term internal auditing and operational auditing interchangeably. But it is inappropriate to conclude that operational auditing is only done by internal auditors, or internal auditors only do operational auditing. These internal auditors do both operational auditing and financial auditing. They have the advantage in doing operational audit as they spend all their time working for the company as compared to other parties that also perform operational audits. These internal auditors can develop considerable knowledge about the company, which is essential for an effective operational audit. The head of internal audit department must report directly to audit committees, and internal audit department also must have access to an outgoing communication with audit committee of the board of directors. So this kind of organizational structure will ensure that the internal auditors remain independent. So this is because if they have to report to the company controller, it is difficult for them to do an independent evaluations. The second group who perform operational auditing is government audit. So different federal and state government auditor perform operational auditing, often as a part of doing financial audit. So government auditor perform performance audit, which consists of 2 types, which is economy and efficiency audit and also program audit. So economy and efficiency audit is performed to assess whether the entity is acquiring, protecting, and using its resources economically and efficiently. What is the reason of inefficiency and uneconomical practice, and also to determine whether the company is compliant with law and regulation related to the matters of economy and efficiency. So, the second one is program audit. Program audit is performed with 3 purposes also, which is to determine the extent to which the desired result or benefit established by the legislature or other body are being achieved. Second one is to determine the effectiveness of organization, program, activities, or functions. And lastly, to determine whether the company has complied with laws and regulation applicable to the program. So the first two objectives of both performance audit are operational in nature, while the last one in the objective is about compliance. So the third group, which is the last one, who perform operational audit is CPA firm. So when a CPA firm does an audit of historical financial statement, part of the audit consists of identifying operational problem and making recommendation that may benefit the audit client. So the recommendation can be made orally, but typically will be included in a management letter. While doing an audit, the external auditor must obtain the background knowledge about client business. So this knowledge usually provide useful information for auditor giving operational recommendation to the client. So the example that I can give is when the auditors audit a company, they found out that the client have a slow inventory turnover. So they should find the root cause of it, right? So in determining the cost, the auditor may find operational causes such as the client have an ineffective inventory acquisition procedure. So the auditor can bring this issue to the management. Client usually engage a CPA firm to do auditing for one or more specific part of its business. So for example, the client can engage the CPA firm to only do audit the efficiency and effectiveness of the company computer system only. So usually, client will engage with CPA firm for this type of audit only when they do not have internal audit staff or their internal audit staff is lack of expertise in certain area. In some cases, management will outsource the entire internal audit function to a CPA firm. So, that is the wrap up for my part, and thank you. And I will pass the presentation to the next person, which is Balkis. Thank you.
My name is Balkis Danisha, and now I will talk about the two most important qualities for an operational auditor, which are independent and competent. Independent is seldom a problem for a certified public accountant from auditors because they are not employed by the company being audited. Independence means that the auditor is free from bias, conflicts of interest, or undue influence from the organization being audited. This ensures that the audit results are objective and trustworthy. So for example, a school hires an auditor to review its finances. The auditor should not be related to the school staff to ensure an unbiased review. To maintain independence, the auditor should not be involved in the operational activities they are auditing. Also, there should be no familial or financial relationship between the auditor and the organization. Then, the auditor should report to a level within the organization that is free from influence by the areas being audited. Next, competence is necessary to determine the cause of operational problems and to make appropriate recommendation. It refers to the auditor's knowledge, skills, and experience necessary to perform the audit effectively. An operational auditor must understand the industry, the specific processes being audited, and relevant regulation or standard. So for example, a restaurant hires an auditor to inspect its kitchens. The auditor must know food safety standard to provide an accurate assessment. To ensure competence, the auditor should have formal education in accounting, businesses, or related field. Then, they should hold relevant certification such as Certified Internal Auditor or Certified Public Accountant. Lastly, continuous professional development through training and staying updated with industry trends and changes in regulation is crucial. Now, let's focus on the specific criteria that are usually desirable to establish before starting an operational audit. These criteria serve as the benchmarks against which the audited processes will be evaluated. Establishing clear criteria upfront ensures that the auditor is focused, objective, and aligned with the organizational goals and standards. So for example, regulatory compliance,
internal policies and procedures, industry standard and best practices, efficiency and effectiveness, risk management, financial controls, and customer satisfaction and quality. There are questions that might be used to evaluate plans layout. The first question is, were all plans layouts approved by Home Office Engineering at the time of original designs? So the purpose of this question is to assess whether the plans layouts were initially vetted and approved by a central engineering team to ensure they meet corporate standards and best practices. The second question is, has Home Office Engineering done a re-evaluation study of plan layout in the past 5 years? So, the purpose of this question is to determine whether the plan layout has been periodically reviewed to adapt to changes in technology, processes, or business needs. The third question is each piece of equipment operating at least 60% of capacity for 3 months or more each year? So the purpose of this question is to assess the utilization rate of equipment to ensure resources are not underused or overused. The fourth question is, does layout facilitate the movement of new materials to the production floor? So the purpose of this question is to evaluate whether the plan layout support efficient material flow, minimizing delays and handling costs. So number 5, does layout facilitate the production of finished goods? The purpose of this question is to check if the layout supports smooth and efficient production processes. Number 6, does layout facilitate the movement of finished goods to distribution center? So the purpose of this question is to assess whether the plan layout support efficient movement of finished goods to distribution center, ensuring timely delivery. So number 7, does the plan layout effectively use existing equipment? This question examines whether the current layout maximizes the use of existing equipment. Last but not least, is the safety of employees endangered by the plan layout? So the purpose of this question is to evaluate whether the plan layout ensures a safe working environment for employees. When evaluating plans layout or any operational aspect, it's crucial to establish clear criteria to measure performance and effectiveness. There are 4 key sources of criteria. The firstly, historical performance. It is based on actual results from prior periods such as historical data, trend analysis, and comparative analysis. The implication of this criteria, we can provide a realistic and context-specific benchmark. Also, help identify areas of improvement or decline over time. Secondly, benchmarking. It involves comparing an organization's processes, performance metrics, and practices against those of leading organizations in the same industry. It helps to identify best practices and performance standards. Entities within or outside the client's organizations may be sufficiently similar to the client's organization to use their result as criteria. As a result, we can identify performance gaps and areas for improvement and encourage adoption of best practices and innovation. Thirdly, engineer standard. Auditor can use time and motion studies to determine efficient production output rates. The outcome from this criteria, we can provide highly accurate and objective performance criteria and helps in optimizing processes and improving efficiency. Lastly, discussion and agreement among stakeholders, including management, employees, and sometimes external experts. It is to ensure that criteria are realistic, achievable, and accepted by all parties involved. These parties involved should include management of the entity to be audited, the operational auditor, and the entity or person to whom the finding will be reported. It is to ensure buy-in and cooperation from all stakeholders and sets realistic and achievable goals based on practical insights. That's all from me. Now I will pass to the next presenter.
Assalamualaikum and a very good day to you, madam. My name is Naina Nazira binti Muhammad Saimi, and I'm going to present about the phases in operational auditing. We're going to look into a deeper meaning of planning, evidence accumulation, and also evaluation, and the reporting and also the follow-up of these phases. Okay, so for planning, we have 5 components that is important to these phases. So the first one is scope of engagement. It is the process of setting out the mutually agreed term of engagement between us. Next is staffing. Staffing is which the team has necessary knowledge and skills to carry out the audit within the specific timeline. Next is background information. So this background information is to help understand the business processes, risks, and also a control environment. It also can help the efficiency of the auditing processes. So next is understanding internal control. It is to identify the idea of risk and determine the extent of testing required. Last but not least is decide on appropriate evidence. This is the audit conclusion that are well supported and also reliable if it's based on the auditor's judgment. For audit evidence accumulation and evaluation, we usually have 7, which is documentation, client inquiry, analytical procedure, observation, re-performance, and so on. But in these phases in operational auditing, we usually just use 4, which is documentation, client inquiry, analytical procedure, and also observation. So we're going to look into each audit evidence. So the first one is documentation. Why the documentation is needed? It is because to record to substantiate the information that should be included in the financial statement. So we need the documentation and also for example, invoices, we need debit memo, credit memo, something like that. So next we have client inquiry. It is to obtain of written or oral information from the client in response to questions from the auditor. So we need a written and also the oral information from the client. So we need to answer the question from the auditor. Next is analytical procedure. It is to identify the unusual transactions or trends that may indicate potential issues that may cause fraud, that may cause misstatement in the financial statement. Last but not least, we have observation. It is required for the auditor to use the audit evidence of observation. Why? It is for the use of senses to assess client activities. So we need to evaluate based on what we see. We need to make a judgment based on what we saw on the field work. Okay, for reporting and also follow up, in operational audit, the report is usually sent only to management. So with the copy to the unit being audited, the lack of third-party users, it can be reduced the need of standardized wording in operational auditing report. So next is the diversity of operational audits require a tailoring of each report to address the scope of audit, findings, and also recommendations. This is what is needed and also important when we do a reports and also follow up the operational audit in planning. I give you 3 examples from textbook. 3 examples of operational audit findings. So the first one is outside janitorial firm saves $160,000. So how? So this an internal audit found the state's capital's in-house janitorial service was inefficient and also inexpensive. So the They recommended outsourcing, and a study showed potential cost saving and improved quality of the janitorial firm. So the states followed the recommendations, hired an outside firm through competitive bidding, and achieved significant cost savings, exceeding expectations, along with improved cleaning quality. Next, the second example is using the right tool. So an audit found a company was leasing too many heavy-duty trucks with expensive hydraulics lifts. So most service calls for vending machine didn't require the lifts. So the auditor recommended replacing most trucks with cheaper vans. So and then management has agreed to the recommendations, and leading to an estimated annual saving of $25,000. The last example that I'm going to explain to you is computer programs save manual labor. So so how computer programs save manual labor is when an internal audit of the company's profit sharing plan not only satisfied the mandatory EBISA testing but also offered valuable operational improvement through an additional review. So the IT team's contribution was particularly noteworthy. They developed computer programs that streamline testing for eligibility and data accuracy. So uncovering discrepancy and ineligible participants, management addressed these issues, and recognizing the program's effectiveness, decided to keep them as permanent controls. So the profit sharing plan manager now use this program regularly to ensure ongoing accuracy in the plan. That is the end of our presentation. I'm representing my group. I would say thank you so much for staying with us till the end, and have a nice day.